Every day we spend a few dollars without thinking. A coffee, a snack, a small expense we won't remember tomorrow. But what if I told you, let's say you spend $5 a day, $24 a week, that same amount could turn into a source that pays you regular income every month? It sounds impossible, I know, but I spent years learning finance from the inside, then made millions in digital marketing, and here's what I saw. The real big money is in money that works with patience. In this video, I'll explain exactly that. I'll show you how to start with $24 a week, how dividends work for you, why compound returns will outpace you over time, and how a handful of carefully chosen stocks create real long-term cash flow. I'll also talk about the dividend mistakes that trap you in stocks. And in the end, I'll show you how this strategy and the selected portfolio transforms a $24 weekly contribution into a $500,000 portfolio, paying over $8,000 a month in passive dividend income. All for the cost of one lunch a week or cigarette money. But before we get to stocks, let's take a step back, because this entire strategy rests on one simple idea: dividends. A dividend is a small portion of a company's profits distributed to you, the investor who owns a piece of that company. Not every company pays them, but those that do are generally solid businesses that earn steady money year after year. Here's how it works. When you buy shares of a dividend-paying company, you become entitled to receive a regular payment for each share you own. If the company pays $1 per share and you own 100 shares, you get $100. Most companies do this every 3 months, some monthly or annually. The size of the payment depends on a concept called dividend yield. It's simply the percentage of what you earn in dividends relative to the stock price. For example, if a stock is $100 and pays $4 in dividends per year, that's a 4% yield. What makes dividends powerful is that they pay you without forcing you to sell your shares. Your money keeps working for you, providing cash flow while the stock value grows. And as companies increase their profits, they often raise those payments too. This is called dividend growth, and it's one of the most powerful engines of long-term wealth. This combination of stable income and long-term growth is what makes dividend-paying companies so attractive to investors focused on passive income. But there's one decision that looks small at first and multiplies growth enormously. When you start earning dividends, you face a simple question: do you take those earnings as cash, or do you reinvest them? There are two main approaches. The first is the non-drip method, where you simply take the dividends as cash. The second is DRIP, which stands for Dividend Reinvestment Plan. Let's make this concrete. With the non-drip method, your dividends go directly into your account. Let's say you invest $1,000 in a stock and receive a 5% dividend yield. At the end of the first year, you get $50, another $50 the second year. By the third year, you've earned $150 in total. Simple and straightforward, but your original $1,000 doesn't grow unless you add more yourself. Immediate income, no growth. DRIP is a little different. With a dividend reinvestment plan, that $50 doesn't just sit in your account, it automatically buys more shares of the same stock. If the stock is still $100, your $50 at the end of year one buys half a new share. Now you own 10.5 shares instead of 10. In year two, your dividend is calculated on 10.5 shares, about $52.50, and that gets reinvested too. By year three, you're earning about $55 in dividends and now own about 11 shares. You didn't add a single cent, your dividends did the work for you. Let's put the two methods side by side. With non-drip, you earn $150 in total dividends over 3 years, and your investment stays at $1,000. With DRIP, the reinvested dividends grow your total to about $1,157, and you've also generated $157.25 in dividend returns without doing anything. That's the power of compound returns. Your dividends buy more shares, those shares produce more dividends, and the cycle keeps going. Like a tree dropping seeds, each one growing into another tree that produces even more. You reap what you sow. It starts slow, but in later years it turns into exponential growth, especially if you're investing in companies that raise their dividends every year. The measure of this growth rate is called CAGR, or Compound Annual Growth Rate. It's a fancy term, but the meaning is simple. Your income grows faster than the previous year, every year. The difference between taking dividends and reinvesting them might seem insignificant at first, but 10, 20, or 30 years down the line, the difference is enormous. But before we get to numbers and stocks, it's just as important to know what not to do, because a few mistakes made early on can quietly slow your growth for years. One of the biggest mistakes investors make is chasing high dividend stocks. Yes, I understand seeing a stock paying 8 or 10% is exciting. It feels like free money, but most of the time this is actually a warning sign you should not ignore. If a company's dividend is unusually high, it could mean the stock price has fallen or the payout has become unsustainable. When profits decline, companies cut dividends, your income drops, and the stock price sees the bottom. That's called a dividend trap. The next biggest mistake is ignoring the payout ratio, that is, how much of the company's profit is being paid out to shareholders. A healthy payout ratio allows the company to retain enough profit to reinvest and protect the dividend during tough times. If the ratio is too high, the dividend may not be sustainable. You're always looking for balance, a company that pays shareholders while still leaving itself enough room to grow. Another mistake is trying to win the game with a single card. If all your dividend income comes from a single stock or a single sector, one bad quarter can ruin your entire plan. That's why diversification matters so much. Investing across different sectors keeps your income stable when one area struggles. And finally, there's a mistake investors frequently make: taxes. Dividends are generally counted as taxable income, meaning a portion of what you earn could go to the government. The exact amount varies depending on the country you live in, so planning for this ahead of time is the smartest move. A smart way to handle this is by using tax-advantaged accounts, like a Roth IRA or a 401k. When you invest through these accounts, your dividends can grow and compound every year without being taxed. With a Roth IRA, you invest money you've already paid taxes on, and then all the growth, including your dividends, comes out completely tax-free in retirement. That's a huge advantage. You get to keep every cent your portfolio earns. The good side of this is, once you learn these traps and how to navigate around them, you'll be far ahead of most investors. In the next step, I'll show you how to select stocks, and in the end, I'll show you how the selected portfolio turns $12 a week into a $500,000 portfolio, paying over $4,000 a month in passive dividend income. But first, let's look at how to build a stock selection criterion for your portfolio and which sectors to invest in. Finding the best dividend companies isn't about chasing the highest yields or famous names. It's about balance, finding stocks that give you strong income today while also preserving future growth. On the topic of dividend yield, this is the percentage of a company's stock price that it pays back to you each year. A good yield provides stable income, but if it's too high, it can be a warning sign. For healthy companies, in terms of dividend income, the ideal range is generally between 2 and 5%. This range keeps the dividend sustainable and leaves room for future growth. Then there's dividend stock growth. This is really very important. When a company raises its dividend every year, it's like getting a pay raise without moving a finger. We measure this with CAGR. It simply shows how much payments have increased over time. The more consistent the growth, the stronger the company's long-term commitment to remembering and rewarding its shareholders. After that, you need to look at the company's financial strength. The most reliable dividend-paying companies are those that generate steady profits, have manageable debt, and strong cash flow. These are businesses that can keep paying dividends and even strengthen financially even when the economy takes a hit. And although we talked about diversification earlier, it's worth considering it now from a balance perspective. You want a mix: a strong utility company, a reliable industrial firm, a bit of technology. That way, you won't be playing a single card on a single sector. Finally, think about the total return, not just dividends. Some companies may have a modest yield, but they grow quickly over time and your overall gain ends up much higher. What truly builds long-term wealth is this combination of stable income and long-term value appreciation. When you put together a healthy yield, consistent growth, strong balance sheets, and good diversification, You get a portfolio that doesn't just pay you dividend income right now, but keeps growing with you. It's actually like building a business. And as a business grows over time, the same logic applies here. We're actually building a business. Now let's put all of this into action one by one. Here are 5 dividend stocks that fit perfectly into this $24 a week strategy, each one chosen for its balance of income, stability, and long-term potential. Each was selected with consideration for dividend yield, growth potential, and long-term stability. Let's start with the foundation of the portfolio, the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. This gives you instant diversification spread across many high-quality dividend-paying companies all at once. It has a 3.76% yield, a 10.43% dividend growth rate, and recorded approximately 8.26% annual price growth. Next up is NetEase, ticker symbol NTES. NetEase is a major Chinese technology company known for its role in gaming and e-commerce. Its yield is lower at 1.89%, but what really stands out is its incredible 24.82% dividend growth rate and 19.36% annual price appreciation. NetEase brings high growth to the portfolio. It's the piece that keeps lifting your overall returns upward while your income compounds. The third stock is Morgan Stanley, ticker symbol MS, one of the strongest and most respected financial institutions in the world. Its dividend yield is 2.58%, but it has an exceptional 22.4% dividend CAGR over the past decade. Combined with 17.18% annual price growth, Morgan Stanley is a true growth and stability pick that offers consistent dividend increases alongside strong long-term value appreciation. Then comes CubeSmart, ticker symbol CUBE, a real estate investment trust focused on self-storage. What makes storage such a strong business is that people need it in both good times and bad. That reliability shows up in CubeSmart's numbers: a 5.17% dividend yield, a 12.51% dividend growth rate, and 3.8% price appreciation. Cube gives your portfolio a stable income base you can count on no matter what the market does. And finally, there's Illinois Tool Works, ticker symbol ITW, a diversified industrial company that has been around for over a century. It has a 2.47% dividend yield, 11.79% dividend growth, and 11.75% annual value appreciation. ITW represents the steady compounding core of your portfolio, not flashy but consistent and reliable over time. When you put these 5 together, SCHD for diversification, NTES for high growth, Morgan Stanley for financial strength, CubeSmart for income stability, and Illinois Tool Works for long-term compounding, you've covered every base. This mix of yield, dividend growth, and value appreciation is what makes it possible for a small weekly contribution to snowball into thousands of dollars in monthly income over time. The next step is calculating the portfolio dividend yield. That is, how much return or income all the stocks give you in total. The simplest way to do this is by using a very simple averaging formula, since you're investing equal amounts of your $12 weekly contribution into each of the 5 stocks. Here's how it works. Start by listing the dividend yield for each stock. SCHD pays 3.76%, NTES pays 1.89%, MS pays 2.58%, CUBE pays 5.17%, and ITW pays 2.47%. Then add them all together. 3.76 plus 1.89 plus 2.58 plus 5.17 plus 2.47 equals 15.87. Then divide that total by the number of stocks, which is 5. 15.87 divided by 5 equals 3.17%. This means your overall portfolio dividend yield is 3.17%. In simple terms, for every $100 you invest across these 5 stocks, you can expect to earn about $3.17 in dividends per year before factoring in dividend growth or reinvestment. Now you can use the same simple averaging formula to find your portfolio's dividend growth rate and annual stock price appreciation as well. Using the same five stocks, the average dividend growth rate comes out to 16.39%, and the average annual stock price appreciation is 12.07%. So what does all of this actually look like if Cato sticks with $24 a week? Let's walk through it step by step. Cato is investing $12 a week, which adds up to $624 a year. That will be his balance at the end of 1 year. After 5 years, Cato's portfolio will have reached approximately $4,263 in value. Fast forward 10 years, and his portfolio is projected to grow to about $13,423. By year 20, his portfolio is expected to be worth around $85,600, and that's when you start seeing serious momentum. His money will be working harder than he is, and the growth will be accelerating on its own. By year 30, this simple $24 a week habit is projected to turn into a portfolio valued at roughly $593,680. Now let's look at the part that really matters, the income. At the 30-year mark, Cato's portfolio will generate approximately $52,167 in annual dividends, or about $8,347 every month. That will be a completely passive return and second salary, built entirely from a $24 weekly contribution. Here's the mechanism behind those numbers. Of the final total, about $327,935 will come from capital appreciation, meaning the stock's growing in value. Another $246,413 will come directly from reinvested dividends, money that keeps making more money over and over again. Put it all together, and that's $574,348 in added value created purely through compounding. And from Cato's pocket over 30 years, only $18,720 came out. Thank you for listening to me. Don't forget to subscribe to the channel and like the video.